So, what happens when Wall Street's classic playbook of pressure and leverage goes head-to-head with a new breed of crypto company? Well, you get this fascinating strategic war. And today, we're going to dive into a company that was designed from the ground up to be completely bulletproof against a traditional financial attack.
You know, it's really the central question for any publicly traded company with crypto on its balance sheet. So how do you build a defense against the most powerful forces in traditional finance? That's exactly what we're going to break down here.
So what we're really looking at here are two completely different philosophies at play. In one corner, you've got a company like MicroStrategy using debt to acquire assets. Now, it's a powerful way to grow, and it's a big but, it creates this massive vulnerability. In the other corner, you have Bitmain with a zero-debt spot ownership model, and their goal is simple: be completely immune to that exact kind of pressure.
All right, so let's start with the attack. Because, to understand how to build a fortress, you first got to understand the weapons of your opponent. This is the traditional finance or TradFi playbook in action.
See, this attack isn't just one single thing. It's a chain reaction, kind of like a line of dominoes. It all starts with the technical move, hiking margin requirements on a company's debt. That pressure then kicks over the next domino, a coordinated media and analyst campaign designed to spread fear, uncertainty, and doubt, what the crypto space just calls FUD. And the ultimate goal? Topple that last domino, triggering investor panic and ultimately forced selling.
And look, this isn't just some theory, right? We literally saw this play out with MicroStrategy. For a company that's leveraged up to its eyeballs, a sudden change in margin requirements, well, that's like someone changing the rules on you in the middle of the game. This was the big catalyst that kicked off that whole domino effect, forcing them to scramble.
And the impact, it was brutal, and it was fast. In the wake of this whole pressure campaign, MicroStrategy stock just plummeted. We're talking roughly 40%. It's just a really stark, powerful reminder of how potent that combination of financial pressure and negative sentiment can be.
So, when you boil it all down, it really comes down to one thing: debt. Debt is the vulnerability. It's the hook that traditional finance can grab onto to exert their influence. If you don't have debt, there are no margin requirements to hike and no collateral to call. And understanding this problem is the entire foundation for the other strategy we're about to explore. Okay, so enough about the attack. Let's totally flip the script here and look at the defense. This brings us to Bitmain, ticker symbol BMNR, and their strategy, which is designed to be immune to everything we just talked about.
And this number, it says it all. This is the first and most important pillar of its entire strategy. Zero. Zilch. Nada. By having absolutely zero corporate debt, BMNR basically neutralizes that main attack vector. There are just no levers for an outside institution to pull.
Now, how is this even possible? Well, it's because of a really critical concept: spot-owned assets. All that means is they bought their stuff outright, with cash they already had. No loans, no strings attached. They are owned free and clear. And the key part is this: they cannot be forced liquidated by anyone else. This is the foundation of the fortress wall.
And listen, we are not talking about some small-time operation here. The scale of this treasury is just massive. They're holding, get this, 3.63 million spot-owned ETH. And on top of that, they're sitting on a huge $800 million cash reserve, what they call dry powder, plus a holding of spot-owned Bitcoin. But here's where it gets really interesting. Take a look at who's backing this strategy. Alongside big crypto-native players like ARK Invest and Three Arrows Capital, you find a very familiar name: JP Morgan. Yep, that's right. The very same institution whose actions put the squeeze on leveraged companies is also a significant shareholder in this untouchable model. You can't make this stuff up. It's the classic Wall Street move, right? Hedge your bets. But a good defense isn't enough. You need offense too. The second pillar is where this strategy goes from purely defensive to offensive. It's about creating a self-funding engine powered by ETH staking. They basically use their massive pile of Ethereum to help secure the network, and in return, they earn rewards.
And those rewards are significant. This staking engine is projected to generate over $300 million in income for BMNR every single year. This isn't a one-time game. It's a steady, recurring stream of revenue that's generated directly from the assets they already hold, creating this high-margin, predictable cash flow.
So, what do you do with all that cash flow? Well, this is where the strategy gets really aggressive. The third pillar is a massive $1 billion share buyback program. And just to put that into perspective, that is a huge percentage of the company's entire market value.
What this does is create this incredibly powerful self-reinforcing loop, what they call a flywheel effect. So the staking generates the cash. That cash then funds the buyback, which takes shares off the market. With a smaller supply, each of the remaining shares becomes more valuable. It's a cycle where the company's main asset literally funds the growth of its own stock.
Okay, wow. Let's take a deep breath. Let's put all these pieces together and see what this final showdown between these two opposing models really looks like.
I mean, when you put them side by side like this, the contrast is it's stark. On one side, you've got MicroStrategy, leveraged, vulnerable to margin calls, and funded by debt. On the other side, Bitmain, zero debt, no external vulnerabilities, and totally self-funded through its staking yield. The difference could not be clearer.
So there you have it, the complete Fortress blueprint broken down into 3 parts. First, you have the wall, zero debt for total immunity. Then you have the engine, ETH staking that generates hundreds of millions of self-funding firepower. And finally, you have the weapon, a $1 billion buyback designed to reward shareholders. Together, they form one incredibly cohesive corporate strategy. And all of this leaves us with one big final question, doesn't it? Is this combination, a spotless balance sheet, internal yield generation, and aggressive capital return, the new model for publicly traded digital asset companies? Is this the blueprint for a company that isn't just strong, but actually what's called anti-fragile, a company that literally gets stronger from all the chaos in the market? I guess only time will tell.